I'm Cedric Stewart, team leader at Entourage RG of Keller Williams Capital Properties, back with my good friend Kim Cox from Apex Home Loans. Hello again.
Hello.
This is really important, just like everything else, because I'm speaking to an expert. I'd like to talk to you about mortgage insurance.
Mm-hmm.
I think that it's important that we have this discussion because there are a lot of myths about mortgage insurance, and I'm going to open the floor to you and ask you to dispel some myths.
So mortgage insurance is not always bad. So I know that some people think that they want to avoid mortgage insurance at all costs, but a lot of times when you pay for mortgage insurance, your interest rate is lower.
I'm sorry, can you say that again?
Yes. A lot of times when you pay for mortgage insurance, it means your interest rate is actually lower. So in order to avoid paying mortgage insurance, you typically have to put 20% down on a house.
Yeah.
So that sounds like a lot of money, right? Well, you can put less money down on a house and pay for the mortgage insurance. And you would think that the interest rate would be the same or maybe better if you put 20% down as opposed to maybe 10% down. But it's not always true. So sometimes when you put 20% down, the banks will increase the interest rate to cover that risk, because mortgage insurance is risk coverage for the lender.
Yes.
And when you put the 20% down, the lender no longer has that mortgage insurance coverage.
Right.
So then they raise the interest rate to kind of cover themselves as that
offset
risk. Yeah. So sometimes it's better if you've got 20% to put down to go with 15% down, pay the mortgage insurance for a short period of time, and then let the mortgage insurance fall off, but get the better interest rate. So you just kind of have to evaluate your different options under your particular scenario to make sure, to see whether that's true or not for your situation and whether that works for you.
Right. And I think that it's important that we highlight the words mortgage insurance. It's exactly what it sounds like. And it's not insurance for you. It's for the bank.
Yes.
Because they're the ones giving you their money. So to me, it sounds like a couple of pros are I could get a lower interest rate by having mortgage insurance, and I could keep, I don't know, 10, 15, 17% in my pocket.
That's right.
Right? So those are some clear pros of mortgage insurance, and, well, you know, the not pros.
Yeah. A couple of other things about mortgage insurance. If you have two people on the loan, mortgage insurance is less expensive, typically.
Okay.
Better credit rating means better mortgage insurance rates. So that's definitely important to get your FICO score as good as possible for that purpose. Your mortgage insurance with a conventional loan will fall off when you reach 78% loan to value ratio.
Okay, so if you put down 20%, no mortgage insurance. Also, if your loan to value ratio reaches 78%, which is like if you were to put down 22%.
Correct.
If you will. Okay, so we kind of see what's going on here.
Right. You can request that the mortgage insurance be removed when you reach the 80% loan to value ratio. The lender doesn't have to accept it, but it's a possibility. You could ask for it.
You could ask, yes. Okay.
If you've paid on time, a lot of times they will remove it.
Just please treat me kindly, if you don't mind. Yes. Okay.
Yes.
I learned a few things, as always. Well, I'm sure we didn't cover everything. So if you have more questions about this, please feel free to reach out to us. Our contact information is somewhere down here. Call, text, email, whatever works best for you. And we'll do everything we can to help you out. Thank you so much for this.
Thanks, Cedric.